In this video we're gonna talk about share buybacks. What are share buybacks? Share buybacks consist in public companies buying their own shares and therefore reducing the number of shares outstanding, which are the total shares given to the public. I want to remind you that the market cap equals to shares outstanding times stock price. So the more shares you have, the more the price goes up. In fact, when a company buys back its own shares, it's because they think their price is undervalued and they forecast it to grow in the next years. Obviously, each share is worth more in this case because you take some shares from the public. In the end, it's like removing outstanding shares from the market, as I just said. I want to give you a quick example here. So imagine there are 10 people owning a stock. One of them wants to be out. The business owners will vote to give him funds in exchange of his ownership stake. Now each of the remaining owners has 1/9 of the company and receives 11% of the profits. In this case, EPS grows while PE ratio is maintained. This assures investors that the company has cash for emergencies. It can also be used for compensation to employees. For example, you want to give them shares at a premium price. Also, it is important to note that share buybacks are carried out using retained earnings. So the economic effect is the same as if dividends were used. This doesn't change the fact that companies with share buybacks usually outperform other companies, as we can see in this chart here. Now I'm gonna give you many info. When a company realizes trading low and won't be able to grow earnings a lot, it can buy shares and reward shareholders that keep holding the stock, so it is a good way. It can be done either purchasing shareholders' shares or buying shares in an extended period of time. A downside is that investors can have the impression that this means the company has no more profitable opportunities, or repurchasing shares puts a business in a precarious situation. If the economy goes into recession, for example, it can face financial issues. Companies that give shareholders great returns with a combination of dividends and buybacks and investments are those companies that perform better. The opposite can also happen here, as companies can issue new shares, share dilution, to receive some money. Each share so will be worth less than it used to be. This is a good choice if investments that are made next are worth it, so it can be risky, but if the company is growing, they can dilute a lot of shares. Now you know what these two are, and it will be a lot easier for you to understand.